because we are not looking what we had before in 2010. And I think if the same government does come back, Elliot, this could be the opportunity for the entire for this year. And I think, like, you know, going into the next year, there's going to be a lot of money coming into Greece, which will be buying into the stock market and then driving it. Because let's not forget, Greece has come a long way. They have done structural reforms, but just the last piece of the puzzle is just to be, you know, they just need to resolve that. And once that's done, they are
But that's a major obstacle we're seeing at the moment. The last piece of the puzzle, if you don't put it in, you don't see the picture. And if we have a situation where we have Syriza in power, the bailout and all the austerity measures that the IMF are calling for, they're not going to be, or the Troika is demanding, it's not going to be met. That's a serious blow to getting Greece to that final stage. And people are already talking again about, you know, whether we're going to have a breakup again of the Eurozone. All the work that Germany did is now being thrown into question. You don't take those risks seriously?
We do certainly do think that these risks are very serious for the market. But at the same time, I think it's just a bit of an exaggeration, because the country has done structural reform and they will be able to get this last piece of the puzzle done at the same time as well. Now, what is important for Germany at the same time is, like, they need to also spend rather than just telling other European Eurozone countries that, okay, we need to do this, because there has been heated debate between France and the French minister, like, be careful how you're using the language for between France and Germany. So I think they need to spend more, and they are saying that, okay, we are going to spend more. How much they're going to spend more? It's only 0.1% of the GDP for the next 3 years. What is more important right now, I think, is the coming date for the TLTRO. And let's say how the demand is going to be for that one. Because so far, what ECB has done, they have spent nearly 26 billion euros since October buying ABS and covered bonds. Now, if that demand does pick up on
it's going to have to pick up quite at a really accelerated pace to get to the extra trillion euros that Draghi's talking about. And it doesn't matter whether we have chief executives putting their head above the parapet and saying we're going to take advantage of the teltros. You're not going to get to the levels you need. Sam, jump in here.
Yeah, I'm just reading a report here and, just looking at some of the commentary out there, and everyone's saying that even the take-up of the latest cheap loan advancement from the ECB is going to be weak. And it's just showing that, banks don't need more liquidity. And I suppose one of the funniest comments here, there's a limited amount of free beer that you can drink. Perhaps that sums it up when it comes to providing loans to banks in Europe right now.
Yes, we agree, and I think that's why 11th of December is a very important day, and that particular day will determine what we're going to see in the coming month, which will be in January. Okay, we had when the ECB did the press conference, we had a mixed messages by Draghi. He said, okay, there is a possibility of doing more covered sovereign bonds and then bringing corporate bonds into the market, and then which they could be buying. But then we had a different report after the ECB meeting, and then they said, okay, we are actually going to do this, when Draghi was saying he was kind of downplaying that. And I think the main important thing, what we are focused for the time being, is the TLTRO. But Samantha, all things aside, we still maintain our view that euro would go further down. But two things have to exchange rings among each other. Now, what are two things? It's not only the ECB who are going to keep pumping the money into the market. I think what is really important at the same time is the structural reforms.